Come on in. Come on in. The water is fine. That's right. Hope you guys got your water. We're going to dive right in. You know how it is. You know exactly how it is, in showing people how simple it is to eliminate debt. I've eliminated personally thousands of dollars of debt. We as a company have eliminated billions of dollars of debt with mortgages, apartment buildings being paid off, different avenues, different elements being paid off, different obligations being paid off. You got to wonder, you know, why didn't we know? And this is sad. Why didn't we know about this type of elimination of debt and building wealth earlier? And I say it's simple because it's not easy, right? It's not easy, but it is simple. It is simple. And remember that, when we remember how simple it is to eliminate debt, and when we get that velocity banking mentality down, right? Mentality down, your whole world, your whole world begins to improve dramatically. And so this is what we want to do. We want to go ahead and share with you uh, what we have here so that you yourself can take this formula, right? Or these couple formulas, and then go ahead and share with the family, share with community. I know a lot of you are already teaching this, which is amazing, right? Congratulations. That's amazing. I want you to go as far as possible. You know who really needs it? The title companies, right? The title companies, the car dealerships, brokerages, realtor brokerages, financial services brokerages. They really, really need to know how to talk to their clients and to put them in a frame of mind of not worrying, right? Not worrying about the interest rates. My goodness, man, they're starting to scare people, right? With these interest rates and how they go up. You need to be able to tell your clients, right? You need to be able to tell your customers, your members, whoever it is that you're teaching the velocity banking method to, you got to ease them into the conversation and ease their pain, ease their fears by letting them know, listen, because you know how velocity banking works, you don't have to worry about these interest rates. I got to let that sink in. Well, CJ, aren't you going to explain? Let me explain it. When you know velocity banking, you don't worry about the interest rates, because what velocity banking does, it's possible to turn a 7% interest rate on a mortgage, or you can apply this to anything, okay? And turn that 7% into 1.44%. It is possible. Equivalent, 1.44% equivalent, because you're not paying it the way the bank wants you to pay it. Okay. As interest cancellation specialists, okay, which I am, we cancel out all that interest that the bank to pay. So that 7% is no big deal to us. 8%, it's no big deal. 12%. Even when you're talking about credit cards, you're talking about 24%, 30%, 40%. You realize, well, wait a minute, because I know how to implement the velocity banking method, this percentage does not apply to me. What's going on, Peter? Let's go ahead and answer some questions. When you put all your cash to the credit card and then you don't have access to cash, can you only pay for things in credit? Is this correct? All right, that's a very good question. I'm gonna go ahead and repeat it for everyone because I think everybody needs to hear this. What's going on, LP? The abstract, Lloyd. When you put all your cash to the credit card, and then you don't have access to the cash, can you only pay for things in credit? Now, there are some companies that are only going to allow you to pay for things by credit. Okay. However, however, if that's the case, let's go ahead and make sure that those that we can't pay by credit, that we go ahead and pay by either our debit card, the check, or the money order. There are some places that are still old school with it. We do have to make sure that we're going by their laws and their regulations. Hopefully, that's not too much. But at the same time, if you want to go ahead and take that kind of that transaction fee, right, or that advance, right, which I know it's going to be some percentage, but remember, when you're talking about an advance, let's say you get charged 16% on an advance, right? Okay. And you're paying this bill. You got to remember, hey, is this 16% advance, this hit, this fee that I'm going to get charged, right? Is it worth me taking out this advance? Because some cases it may be worth it, and some cases it's not worth it. Okay. And that's why, we definitely sit down right with our clients, our members, our customers, and we explain, listen, this is way worth it. Taking that hit, taking out the credit card, right? Advance. We take out that money, that $1,000, that $2,000, because guess what? It's going to save us $3,000, right? In interest, not in the long run, in the short run. That's how we're able to pay off a 30-year mortgage in as little as 5 to 10 years, because we're canceling out all of that interest. And so, can we take that 16% hit, taking out $2,000? Now, that may sound like a lot, man, doesn't it? Doesn't it sound like a lot? Let's be real. That does sound like a lot. Okay. We're talking about 16% multiplier. Okay. But how much in interest is going into our pockets? That's what velocity banking is doing. It's ensuring that you save massive amounts on the back end. All right. So, of course, on the front end, you're going to pay, right? That 16%, that 20%, whatever the advance fee is. Okay. I know for many of you, it's 3%, the advance fee. But if it's going to save thousands of dollars, then we need to consider, wait a minute, I can take the hit now or I can take the hit later. And that's totally up to you, what you decide to do, who you're teaming with, right? That's you all. Okay. I know how banks make money, all right? And all this method does is it teaches you how to think like a lender versus a consumer, the lowest on the total pole in financial economies, all right? Financial ecosystem. There's consumers. Okay, let's go ahead and just break this little tidbit down here. You guys know about the velocity banking method. Look, genius questions here. Very good questions. We're going to get to all of them. All right. But there is consumer, there's producer. Uh-oh. You hear that, don't you? People waking up right now. All right. And then there's lender. All right. Where you want to be at mentality wise, hey, maybe you like being a consumer, maybe you like being a producer, but where you need to be at mentality wise is lender. And that's where velocity banking comes in. Okay. You need to be thinking like the lender and not just looking at the front end. You need to look over and you need to look within and say, well, wait a minute, if I can save $3,000 of interest. This 16%, this little piddly 16% in interest that they're charging me right now on the $2,000 is way worth it. So that's a great question, Peter. Man, I got all that from that. My goodness, man, that's what you get for having smart commenters. Hey, I'm looking forward to talking to you finally, Lloyd. Absolutely. And the abstract, and then that's a great one too. If you really need cash, just stash some away or make a savings account. This way, if you need some cash, you can pull it out. That does make sense. The abstract, absolutely. What I was doing was I was only going over the mentality of it. I know there's a lot of people that are in fear because of the interest rates, right? But that is a great, hey, that's a great comment. The abstract, thank you. All right. And that's okay. You know what? LP, guess what? Guess what? We can help you with that. All right, we can help you with that. I understand. Let's go ahead. I know a lot of you know that I make room for you. So let's go ahead and get and make some room. Can we? Can we go ahead and send you the link so that we can make room for you? Absolutely. We'll make room for you, LP. Come on in. Come on in. It is funny. It is funny, Peter. He said, ain't it funny? How having cash psychologically, it feels more comfortable than having less debt, you know? Yep, 29. Yep, that's why we absolutely say 40% and all these astronomical interest rates. That's why we do that on purpose to show you the strength of the velocity banking method. All right. So let's go ahead and go through an example here by our friends, our favorite couple, John and Rebecca. We're going to go ahead and show you just a little bit, okay? Just a little bit of what we got going on here. Let's share this for you. There we go. I'm going to go ahead and make sure that we're sharing another screen. Can we share our other screen? I think this one's going to be really good. Show all them windows. There we go. We want to share that one right there. Boom. Can you guys see that? I want you guys to see that. Okay. I want you guys to see this. So here we have the income. You remember from yesterday. Look at the average discretionary income. Okay. The average discretionary income is $53.17. Okay. And you're wondering, well, wait a minute. So this couple has two mortgages. They got CJ1 mortgage. They got the first mortgage. And they got $482,900 in principal remaining. How are they going to pay off two mortgages, all right, in 16.1 years? Well, they're not going to pay off two mortgages in 16.1 years. They're going to pay off two mortgages, a MasterCard, an auto loan, and a signature loan in 16.1 years. Drop the mic. Okay. That's what they're going to pay off in 16.1 years. Now, let's go ahead and see if we can't make sure our MasterCard, right? Let me go ahead and put of course, man, anytime you go live, right? You know it can't work smooth, right? You know it can't work smooth. Uh-huh. Anytime you have a MasterCard or anything with an interest rate, what you got to be aware of, you got to be aware of the interest rate when it goes from that zero. Remember that balance transfer card? They get that promotion going. We got 0% in 18 months, 0% in 12 months. You got 0% in 24 months, right? Look, you got to be aware that it's not going to be 0% forever, right? So we go ahead and look at our money allocation plan. We look at our MasterCard and we look and we say, well, let's see if we can edit. Let's see if we can edit. So this is a rate of 18.49%, y'all. Okay, 18.49%. But what if it was at 40.49%? Credit limit at 25,000. Start balance at 5,500. All right. What if it was at 40.49%? Now, this is unrehearsed, right? This is unrehearsed, folks. I don't know what the answer is going to be, but I do know this: I don't have to calculate it. That's why we put up our remarkable. All right. We're plugging and we're playing, and this is now what we're saving. So now it's at 40.49%. Well, if it's a 40.49%, can someone please tell me why is it that we're still going to pay it all off in 16.1 years? Why is that? With a potential of $177,097 saved. How is that? It's all in how we allocate our funds. How are we allocating our money? Are we leaving it in savings? Are we leaving it in our retirement accounts? Are we leaving it there? Or are we saying, you know what? I need to start moving these funds around in a way that'll actually work for moi instead of for the banks. And so that's what these little red and blue squiggly lines are. It's letting you know, hey, send this money in the checking to the savings, send $232.26 to the savings. Then from the savings to the MasterCard, I'm gonna need you to send $1,243.46. You know what I'm saying? It's letting you know this is how you're paying it all off. This is how you're going to be saving over $177,000. Oh, and by the way, without starving. Oh, by the way, no beans and rice diet. Oh, by the way, you don't have to cut up your credit cards. Okay. Listen, do not cut up leverage. Never cut up leverage. Okay, folks? Never cut up leverage. Just because other people are failing at it doesn't mean you have to fail at it. That's what direction is for. That's what we're here for, right? That's what help is. That's why this community is here for. This isn't my channel. It's our channel. You see what I'm saying? Those that got up out of the pit and paying off, eliminating thousands, and as a company, billions of dollars worth of debt. What's going on? So, question: what happens with the credit cards? Do you stop using them until they are paid off? I tell you what, never stop using them. Never stop using them. And you just saw a little bit of how that money was allocated, right? You see a little bit of about how that money was allocated. Because if you need to save for a vacation, guess what you can do? And that'll be in the next video. You got to use your credit card, right? All right. So how is the credit card going to get paid? Watch this. Checking to savings, right? Then you got savings to MasterCard. The trick is to leave a spread within that MasterCard. That's what's going to be paying it down. So if you've got $2,000 coming in, $1,000 coming out of the MasterCard, right? That $1,000, 2,000 minus 1,000 is 1,000. That's what's paying the card off. That's why you'll never have a minimum monthly payment. Do you see a minimum monthly payment here? Look. Do you see a minimum monthly payment at all on your MasterCard? $1,243.46 on a $5,500 balance? That's the minimum monthly payment? No. No. What about next month? All we got to do is add a finance charge there, right? And if you need to use the MasterCard, you can. Okay. That's what it's for. It's not the complete, no, I'm never gonna use my card again, man. You know, I got it. No, 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 no. Now that you know how, right? Now that you have a tool that's gonna help you, right? You're gonna log in what, about 10 minutes a month and just go down. Okay, let me see what we got to do here. Listen, it's letting you know where to move the money. So you don't have to worry about, oh man, what about my finance charge? Well, what about the savings? What about my checking? What about food and dining? That concern is gone now, right? Because now you have something that is concrete, something that's going to let you know, hey, this is what you need to do with your money. If you need to go on vacation, you need to use this MasterCard, then let's go ahead and use the MasterCard the right way. This is how you do it on the 5th, on the 7th, the 8th, the 16th, right? The 20th, the 31st. This is how your money is to be controlled. If you want to pay off 2 mortgages, signature loan. Let's see what else we got. 482,000, over $482,000 worth of principal, a signature loan, MasterCard, and 2 mortgages in 16.1 years without starving yourself to death. That's how you got to do it. All right. Now, I don't know what's working for you, right? Or if you're paying a gargantuan amount towards the mortgage companies and you're receiving nothing. But we do understand this, right? That the potential of interest saved here is $177,097. Oh, and by the way, when that 2 mortgages, what I was talking about, that's with no renters. That's no renters. How many of you believe in no renters and multiple mortgages? Hmm. That's why you're only getting $53.17 in this scenario, but you're still paying off 2 mortgages in 16.1 years with an income of $5,444. How in the world can you afford 2 mortgages on $5,444 a month? Math. That's how. It's mathematically possible. Folks, we've got to get into deeper detail on going on vacations, right? Because you can go on vacation. And we're going to go ahead and do that next time. Man, thank you so much for your comments and for your questions. Please, 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 there is the link. You want to go ahead and let me help you with your scenario? Please, please, please. We would love to, right? We send out an analysis worksheet. We go through your scenario. We let you know, hey, this is what we're dealing with. This is how far you are in debt, and we can bring you out in as little as 5 to 10 years, depending upon your scenario. And if you want to get another building, or another mortgage, we can help you do that as well. Folks, thank you so much for tuning in. We will catch you tomorrow, and we'll be going over some vacation scenarios. Man, it's going to be fun. Thank you. Share this with everybody, right? Because the economy needs our help. And we can help the economy with this, all right? We got to get more people to utilize their lines of credit, to utilize their checking and savings accounts the right way. We got to get them into the chunking principle. And that's going to revolutionize everything. God bless you all. You take care.